Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
Welcome to another episode of Kiss My Assets, and we have a special episode today. We have our friend from Phoenix Mortgage Brokers, Nick Heth. Hey, Nick, how you doing?
I'm doing great. Jamison, how are you?
Doing well. We wanted to have you come on because of everything that's happening with housing. You're someone who really has a pulse of the housing market because you help people get financing for homes. And as we've had conversations over the past several years, I've always found that your insights and what you're seeing is very helpful. So I wanted to pull you in. Let's talk about some details with the housing market. We'll get to those in a minute, but just before we dig into that, maybe if you could tell me top of mind, if you're given the 1 or 2 minute spiel on what's happening with the housing market in the Phoenix area, which is where you specialize, what would you tell somebody?
Yeah, I mean, I would let them know that it's really a seller's market. The amount of listings, people are always, oh, the rates are so high, or worried about qualifying. And I said, I agree with you. I think there are very few interested buyers. There's not a lot of competition. Except for the fact that there's less homes for sale. So it doesn't matter that that home is expensive or that the rate is 7.5%. There's somebody out there that can or will afford it, and you'll be outbid by them. So there's a lot of situations where stuff is hitting the market, first, second day of the listing, and they'll have multiple offers. They'll have potential appraisal waivers. Somebody's been saving longer than you have, and so the sellers are benefiting from that, and home prices are stable, if not increasing, from my perspective.
It's amazing because we saw that during COVID when rates were so low. They were 3%, even sub 3% for a little while. And it made sense that would kind of drive this frenzy. Now that rates are over 7, you would think that would be over. But to your point, even though there are less buyers in a market like Phoenix, there are still more than there is sellers.
Yeah.
Sounds
I
like.
I think from a Phoenix perspective, our business-friendly government environment has a lot of people from California, from Pacific Northwest, moving here, searching for that sunshine. I know we've had 150 straight days of it and no accountable rain, but people like that. It's very reliable as far as if you're going to have a business here, you're not worried about hurricanes or an earthquake or both at the same time. I think, you got data centers here being built. Reliable energy sources are important versus the California where you've got a lot of solar, but you know what, they aren't as reliable as our policies here in Arizona. And then you've got just a lot of the Midwesterners, I grew up in Chicago and now I want to move and retire here. You still have the retirees from the Midwest and East Coast coming here as well. So just all of that is the perfect storm combined with, historically low rates where people don't want to sell. They don't need to sell. The tax laws are catering to people keeping their house and then renting it and then buying the next one. So all of that, just gives us our environment that we're in today.
Yeah, and if anyone who lives in the Phoenix area who spends any time on our freeways, we're starting to see, the freeways are busy. There are people continuing to move here. This time of year, we see even more of the snowbirds who've been away over the summer. Now they're starting to come back and they jam up our freeways. There doesn't seem to be a shortage of people continuing to move to the Phoenix metro area. And I think to your point, there's still a lot of very attractive reasons why. The Taiwan Semiconductor building that is a huge project in North Phoenix. I read an article earlier this week that talked about some of the additional companies who are moving here Now, because Taiwan Semiconductor is going to be here, now you have additional companies who support them, different supplies or parts, and a lot of those jobs are technical. They're high paying, and it really changes the whole ecosystem when you have a company like that to that level coming here. So
I think it's its own incubator. It's got a lot of ancillary businesses that will help support it and build the infrastructure around it. So absolutely.
And that's the interesting thing that we mentioned is even though rates are high, there's a short supply of homes. If somebody comes here and they want to buy a home, they want to settle in, they're going to buy a home. They're going to say, wait, 7.5, historically is not that bad. I mean, if you look at it over the last 40, 50 years, that's actually pretty average. And they're going to say, hey, let's buy a home. We'll always be able to refinance this later if the rates come down, right? Is that kind of, tell us a little bit about the psychology between some of the home buyers that you're working with right now. How do they think about the current interest rates and their monthly payment and buying a home?
Yeah, sure. I think that if I'm talking to a first-time home buyer, I'm first and foremost, you have to qualify for the current rate environment where we're at, right? And then you've got to say, hey, listen, your payment's going to be X, Y, Z. It's going to be $3,000 a month. While that's not great, everybody's also, gotten more raises, have gotten better jobs. You can't say, oh, the home prices are up and the rates are up, and ignore the fact that you've benefited as well from a better job, advancing in your career, et cetera, right? I know that my wife and I were in a situation where years ago when we moved up from our, I'll say, starter house to our current house, it was a relief. We no longer had to save for that next house, and you're able to enjoy life and live life, and just say, hey, listen, we had goals before. Our new goals are to be comfortable in this current house. And then what happens is you fast forward 3 years, 5 years, 10 years later, you wake up and you realize, hey, our mortgage has stayed the same and our incomes have increased, right? So when you lock in a home with a rate today, you have to be able to afford it. But then the important thing is that you'll know, hey, we could refinance down the road. We could get a better job. They're called starter homes for a reason. And then there's a move up home. And when you pay down your balance of principal and interest every month, you'll take those proceeds and move up to the next one. So it's moving from paying rent every month to now we're building equity every month, and it's not something you pay attention to every coupon bill that comes in the mail. But what ends up happening is you have a big nest egg at the end of it.
Yeah, it's kind of this forced savings that you almost don't even realize. And then there's, of course, big tax benefits too to owning a home because they're going to, you can write off that interest at the end of the year. A lot of incentives to do that, even at higher rates. When it comes to lending, have you seen any tightening in the either the loans to value that lenders are offering, or the requiring higher credit scores, more incomes, better debt to income ratios? Have you seen that tighten over the last 6 months?
No, I'd like to think even the opposite. We've come out. There's been new programs. We've got a program. 2% towards borrowers' down payment. If you, up to $4,000. So there's definitely been pushes to make affordability more widespread, and not a tightening. I think the tightening would be, hey, I already have a house, and the home equity lines of credit that maybe would have gone up to 90% are now capping at like an 80% CLTV combination, right? So tightening on, hey, I want to take money out of my house and get into trouble like we did in 2000, I call it 7 and 8. They're stopping that from happening, and then they're trying to expand the bottom to get those first-time home buyers in. As far as the guidelines, I don't see anything that has been a big change in regards to, hey, we're making it harder or tighter. It's really been trying to actually help people as loan volume goes down. I think the creativity and the guidelines expand to help increase that, right? It's a a cycle and flow that way. So they're really trying to get the entry level people in so that it allows that move up buyer to hopefully sell, create a new listing and then buy the next higher price up. So
And in your business, in the mortgage business, a lot of times you're doing purchase properties and then you're also refinancing people. Fair to say that right now you're basically just doing purchases and a one-off refinance, or some people still refinancing for other reasons.
yeah, I think the 3 Ds, death, divorce, and disease, are going to keep the world turning.
Yeah.
And those people will come, right? Like, maybe it's unfortunate circumstances, but those listings happen because, life events happen, right? So there's going to be that segment that probably never go away. It doesn't matter if the rate's 7% or if it's 3%. If you need cash, you need cash now. It doesn't matter, right? And then you have different situations. I know a past client just reached out to do a cash out. They owned the house free and clear, paid off all the debt, and they're not going from a 3% to a 7, right? They're going from 0 to 7, and it's a more
Right.
manageable amount, right? And so if you're building a new garage, if you're remodeling, that's just the cost of debt today, right? It's just a market rate, um, that you have to endure. You can't only borrow if it's only under 3%. That's just not realistic. That was money on sale for a limited time, and that sale's now over. So
Yep, that's right. And the Fed is saying that where rates are at right now is in a restrictive area,
hmm
meaning they've signaled that we're not going to stay here forever. We're going to only stay here until inflation. There's a lot of confidence that has now come down and controlled, and
yeah,
that could be some time, but this isn't necessarily the new normal. It might be for a while, and there's some debate about how long that will last. But one question I have for you, and this is not necessarily factual or something that we're going to hold you to,
sure.
but at what point do you think where interest rates hit a certain level, let's call it 30-year fix, which is kind of the common one that people talk about when they talk about home loans.
Yep.
And right now we're 7.5 is kind of where it's at in that range, right? For a kind of a regular conventional loan. What level does that need to get to where you start seeing people say, forget this, I'm not getting a loan? Is that 10? Is that 9? Is that 8? What do you think?
Oh, or where they just stop altogether?
Where it really just puts a freeze on things, because some people thought that was going to happen already,
Yeah.
and it hasn't.
Well, I can tell you that I think last week we hit, from what I understand, the highest rate since 1999, and that predates my career. So as far as my career goes, we're funded a loan today. We'll fund another one tomorrow, and more this month, right? So we haven't stopped, and the rates are as high as they've ever been, the last 25 years. So I don't think there is a limit. I think people, need money to make the world go round, and it's not going to stop if the rates are 10, 12, 14, 18, right? It may be limited, and the guidelines will change, right? But the money is going to keep going. I don't think it's going to continue to, or absolutely stop, so
If you do a 30-year fixed right now and it's, call it 7.5, but if you say, I'll rather do a 5-year fixed and then refinance later, which it's interesting. In the US we're used to these 30-year fixed, but
mhm.
folks in Europe, they don't have fixed rate mortgages. Theirs are all floating, for the most part, many of those countries. And so as rates have gone up, their payments have gone way up. They don't have these fixed rates like we do. But if I were to say, okay, let me do a 2 or 3-year fix, does that save me what, a half a point, a point? Is that even on the table? Is that an
Yeah,
option now?
it's not on the table. You have to have, two parties to the dance, right? You've got to have a investor who's willing to earn it, and a borrower who's willing to pay it. And from the markets I'm looking at, the ARMs, which historically have been a quarter or maybe a 0.5% lower as a teaser rate, aren't even interested, because they know today's rates are higher. And why would I want to invest, or even buy a note that's a 5-year note that's going to be refinanced in in 3 years, 2 years, 1 year. In fact, I think we've really seen the markets, from what I comprehend, investors need additional yield currently, so the rates are artificially even higher than maybe they would be, because, hey, Jameson's going to get a loan from me and he's going to refi in 6 months, 12 months.
Right.
2008, we saw prepayment penalties really go away. And so, what's to stop you from refinancing a month down the road if rates really do crater, right? So,
So
the
that's
Fed,
kind of baked into the current rates. There's a
yeah,
bit
yeah,
bit there that's
yeah,
driving it up, which makes sense. I mean, if I'm lending money right now, I'd love to lend at this rate for the next 30 years and lock it in and know that I'm going to get that back.
yeah.
Where to your point, we expect rates are going to be going down at some point in the next several years, to a different level. So right now it's a
Mhm.
nice time to be holding that piece of paper as the lender.
Yeah, and that's it. Like, there's a lot of paperwork involved in it, right? So you're gonna have, all this paperwork. Oh, Jameson's gonna pay me 7.5%. That's wonderful. And then 2 months later, oh, I'm gonna refinance. I got 7%, 6.5 down the
Right.
line. So that's just a market dynamic that isn't widely understood, I think, from a consumer perspective.
That's a great point.
Mhm.
Last thing I want to ask you about,
Sure.
just to get your comment and your view. Elon Musk tweeted a month or two ago that he expects home values to crater, that the market at some point is going to have a major pullback. And he says a lot of things, but no matter what he says, gets attention because
Yeah.
of his reputation and his insights. What do you think about that?
I'd have to wonder what the catalyst would be. I think the catalyst would have to be a complete jobs loss, right? I think that, if you've got a home currently today that you didn't buy just yesterday, I mean, everybody we've been doing loans for since 2008, 2009, they have to be qualified, right? And so if I've qualified you with these jobs, I mean, maybe if you worked for a company like Twitter, where they didn't need, as large of a employee staffing that they currently had, and you lost your job, and then you're not going to be able to make your payment. But if you've had the current job for 5, 10 years, and now you have the enormous amount of equity, there's going to be ample opportunities to sell before you would go to foreclosure, and really go through what we did in 2007, 2008, where all these neighborhoods would be like a domino effect, where, hey, my neighbor couldn't pay his bills, so he went to foreclosure. He sold for less. Then I lost my job. I sold for less. Than my neighbor next to him sold for even less. That's what really created this domino effect and cratering of the market. I think right now you have everybody paying down their debt. Nobody's in interest only loans. There's no prepayments. There's nothing tricky about them. So I would have to wonder what the catalyst would be to cause it. Unaffordability is one thing, but rent is also unaffordable. The rents tend to keep going up as people are having a harder time buying. Their alternative is to pay rent, and so if we know that they're not buying, then we can afford to keep their rent going up. So, like I said earlier, it's nice to have hey, my rent is going to be $3,000. My mortgage is going to be $3,000, and it's fixed. And every month I see that amortization schedule, it goes down. The interest amount, which I think of as the rent, is going down every month. How great of a feeling is your rent going down every month versus, even keeping up with inflation? So,
Great point. Yeah, it's difficult to see how in our jobs environment, where we still don't have enough workforce to meet the need
yeah.
of jobs that are posted and available, combined with the shortage of housing that's
Hmm.
available to buy, which is part of why the new home builder stocks have had a rally the last couple months.
Sure.
Berkshire Hathaway just took a big position
Yeah.
in new home builders for that reason, because they're looking at where this thing is going, is that the people want homes, they want to move into them,
Yep.
and when the sellers aren't selling, the home builders are the next people to look at
Hmm.
for supply, and it's hard to see what those dynamics as to why a market would crater like that, and it's beyond just pointing and saying, well, it's gone up a lot, so it's going to come down a lot, which is pretty simplistic.
Hmm.
The fundamentals kind of tell a different story.
And I think also like where you're located is makes a big difference, right? If you're maybe in a city like San Francisco where the businesses are moving away and they're coming here, they're going to Austin, they're going to Texas, they're going to Florida, and then people are dealing with other social issues in their states. Maybe that area will go down, but in certainly in our case, I think we're the ones benefiting from it with a rock solid base of people with low rates and people with jobs that can afford them, and so it just really depends on what environment you're working in as to what the market will do. But here in Phoenix, here in Arizona, I feel very safe. We're in a good position. So.